Hello, I'm Greg Conrad. I'm a CIBC mortgage advisor. A pre-approval for a mortgage is a relatively simple process, and there's actually a couple of different types of pre-approvals. One pre-approval will basically hold an interest rate for a client for a period of up to 90 days, as well as give them a good idea of what they can afford in a home. There's another type of pre-approval which will actually ensure the full credit check and everything is done for the client, and that way they know they can go out and buy with peace of mind. The minimum down payment for purchasing a new home, regardless if you're a first-time home buyer or not, is actually 5% of the purchase price of the home. The minimum down payment for the purchase of a rental property currently is 20%. That amount has actually changed over the last couple of years due to the new government guidelines that were introduced and changed throughout 2012. CMHC insurance is mortgage default insurance. What that does, that actually insures the lender in the event that the buyer defaults on their mortgage. The lender does not lose. There are actually a couple of different companies throughout Canada that provide this service. CMHC is Canada Mortgage and Housing Corporation, which is a government body and one of the providers of this type of insurance. The cost for this insurance, typically whether it is done through CMHC or one of the other companies, is a tiered cost based upon the amount of the down payment versus the purchase price of the home. The biggest difference is the function of what the interest rates actually do. A fixed rate mortgage will be negotiated at the start of your term and will remain constant throughout the entire term of the mortgage. Most mortgage terms are anywhere from 6 months to 10 years, which you would decide at the time of purchase. A variable rate mortgage is a mortgage that will fluctuate with interest rates, typically the bank's prime rate throughout the term of the mortgage. Most variable rate mortgages are 5-year terms and can either be an open mortgage, which can be paid off at any time, or a closed mortgage, which typically is convertible to a fixed rate at any time. The best way to pay your mortgage is paying it set up on a payment that you are comfortable with. Whether that is weekly, bi-weekly, or monthly is entirely up to your own personal circumstances. There is a wide belief that by paying bi-weekly versus monthly, there is a large savings of interest. That is actually a myth and can be saved and set up via any type of payment, whether that is weekly, monthly, or bi-weekly. So therefore, to ensure you have the best payment set up would be to set it up as you are comfortable, not how the lender dictates. I believe the biggest common mistake is not taking into consideration the true costs of home ownership as well as other debts that may be incurred after home ownership. One big thing that a lot of people do not take into consideration is the cash required for closing costs, whether it be legal fees or deed transfer taxes based upon the municipalities they are purchasing in. The other item that is a big concern in a lot of cases are debts or liabilities that lenders typically do not take into account when approving someone for a mortgage. A large portion of these items are typically geared towards younger couples with such things as car insurance or child care. I believe the best reason would be that I do have 18 years of experience in completing mortgage applications and feel that I can use that experience to provide the best level of service for both past and current and new clients.